I'm sharing with you 8 charts which summarize the 8 biggest lies investors believe. If you're an investor or want to be one, you should make sure you remember those. Stay tuned.
3 separate devices. This is one device.
Associate with people who are better than yourself and act.
I'm going to make him an offer, Captain.
Hey everybody, I'm Sam and this is Antiversal. You're watching the episode 7 of the Should I Buy show. In it we're talking about interesting investment opportunities, technology innovations, tips about shaping our investing and financial mindset, and ultimately trying to see where the value is and should we buy it. In today's episode, I believe it will be very interesting, and most of all, it's absolutely crucially important for any investor, I believe, to watch this. And we'll talk about 8 very big lies that investors seem to think, and they basically fool themselves. So I believe that's a video that I would like for me to rewatch every few months just to remind myself, because it's so easy to forget and to get into it and trying to shift your strategy or fundamentals, and you forget what's important. And the 8 charts that we'll look at, they might be a bit scary at first glance, but I believe they give us a message that we should stick to a strategy, we should stick to fundamentals, and we should be thinking smart about things and not just trying to time or to do things that we cannot afford. And let's get started. So the first thing that investors like to think is that something is oversold, so there should be a support there to back it up, right? And there are a lot of charts masters, and I'm not saying that technical analysis isn't working, but it is a fact that a big part of technical analysis is interpretation, right? And somebody might pull a 1-month chart, somebody might pull a 3-year chart, somebody might pull 10-year chart, and there are cups and handles there and supports and barriers, and they can place them all around the place. So I'm not saying don't look at technical analysis, but look at the chart of Valiant Pharma. I mean, there were 20 supports out there, and they were all broken down from the start of 2015 until the middle of 2017. So in 2.5 years, the stock went from almost $220 down to $850, which is just hurts, right? It's crazy. But look at all the supports out there in the technical analysis. What does that mean? That you should always look for the long term, you should always look at fundamentals, and you should not base your strategy simply on some kind of analysis out there. The next chart is exactly the opposite. You must have heard some investors say, oh no, this is overbought, so we can't go higher, it must correct sharply, and so on. Just look at the Nasdaq Composite chart from 1999 to 2000. The overbought territory starts at around 3,000 and it goes up at all-time high at this chart to 5,000. So that's almost 70% up. So, yes, there might be overbought, and in the long term, obviously there was correction, right? It was the dot-com bubble, but can you really time it? Can you really say when it comes? So once more, we should be worried about that, and don't be fooled and just think, oh, that's oversold, that's overbought, so I should react in some kind of specific way. The third chart, it's saying the very simple words, my investment can't go to zero, and that is absolutely wrong, and it hurts, and that's very painful. That's the Lehman Brothers holdings back in the crisis of 2008. I believe we've all at least heard about that story. If you're an investor and you have read about that, it just goes straight to zero from 15. It hurts, but it can happen, so you have to think about that and take it into your consideration. You can't fool yourself. The next chart is housing prices only go up. Every real estate investor just likes telling you that so much so you can invest with them and so on. And I'm not saying that that's not true, but once more, it's up for interpretation. It's up for a timing interval, right? Because if you pull a chart of, the last 100 years, then yes, absolutely, home prices really only go up. But then if you pull a chart which is as that now from 2006 to 2012, obviously the housing prices have gone drastically down. For somebody who could hold their money for 20 years, then yes, they would see profits because the housing prices would go up. But then if somebody cannot afford holding their money for so much time in an investment, obviously for 6 years they would be down. That obviously gets you in a loser mentality. You start worrying. A lot of people can lose money. So don't be fooled by somebody telling you this investment just goes up, because it's always up for interpretation, right? Long term, but how long term is that? 6 years is quite long term, right? But obviously it's down. So is it the long term 20 years? Is it 6 years? Is it 2 years? How much time can you actually hold your money? And will you need them in 3 years when you're 30% down, even though that if you held them for 10 years, you would be 300% up? So all of these things should always be on our minds, and that's why it's so easy to forget. The next chart is the lovely Amazon. This company, who could see what it's now like 10 or 15 years ago? When somebody tells you value is a good reason to short something, right? And then we have to interpret value, right? Is value just a P ratio or PG ratio, or is value something much more complex? And I do believe that value is much more complex than simply a P ratio or even a combination of 2 or 3 ratios. But just to make our case, look at the chart comparing Amazon price and Amazon P ratio. So you can see that back when the P ratio of Amazon was actually much lower, the price of the Amazon stock was growing much lower. And then the ratio starts skyrocketing over 100. In 2015, it goes up to almost 2000 P ratio and the stock price shoots up. Is there really a straight up correlation there, or should we look for value much broader and take into consideration much more things? And especially for shorting, I'm quite not against, but I don't really like shorting. So you have to think about that. The next chart is trying to tell us how hard is actually saying if something is in a bubble and try to call the top of the bubble. And this chart, by the way, is of Bitcoin, and it is up till 4,000. And we know that later in 2017, Bitcoin went to 20,000. So that's like almost 5 times more than what's on this chart, or let's say 4 times and a half. So where is the top, right? Back in 2013 there were tops, then simply in 2016 2017 they've been like 10 or 15 tops, and the price just went higher and higher and higher, and that's like thousands and tens of thousands of percentages up. So how can you call a bubble top and be sure about it? You can't. We cannot time the market. We cannot say something for sure. We have to be smart. We have to have a strategy. Take profits, maybe leave something there, try to evaluate broader aspect of value all the time. Next chart title is value investing is easy. And obviously this chart is for very short time. It's basically in the growth of the dot-com bubble. So it's not like it's absolutely definitive. Obviously in the long term, Berkshire Hathaway is like one of the best investments ever in the world, right? But you can see that value investing is not that easy, especially when we're in a growing market and when something else is hot. You can see that in the 2 year span that you can almost 2 years span in the chart that you're looking, Berkshire is almost negative 50%, while the Nasdaq 100 is 270% up. So obviously that's crazy difference, right? Investing is not easy. You can't just throw your money somewhere and expect to make money, but then you shouldn't be scared about that, because obviously there is opportunity. You can see the opportunity there, the Nasdaq, right? So we have to think about that and remind ourselves. And the last chart, I believe it's actually probably the most important of them all, because if you're listening to that, you're probably a beginner investor or something like that. Even for more seasoned investors that invested for years now, and I try to say that in all my videos and all my descriptions, and for me, I'm trying to remind that thing to me is that you should never be following some kind of gurus and investment specialists and so on. That's why when I'm talking about different stocks and so on, I always tell that you shouldn't buy what I'm talking about. That's just examples to make points about how I think about an investment or something like that. And even now, I'm more and more trying to give a much more general and unbiased view on investments and ideas. Because we can see the chart, right? The RBS, that's one of the biggest investments consultancy banks out there, right? They said that emerging markets all remain sales. So they advise people to sell emerging markets and sell everything except high quality bonds. RBS has advised clients to brace for a cataclysmic year and global deflationary, I'm not sure if I'm saying that right, crisis, warning that major stock markets could fall by a fifth and oil may plummet to $16 a barrel. That's back in 2016, and we know that 2016, 2017 were some of the best year in the stock market ever. High yield bonds were up 20%, which is good, right? But the S&P, which was sell, right, major markets, is 31% up, and emerging markets are 55% up. So what does that mean? It means that even the biggest financial advisors out there, with all the technology, with all the information and data, they make mistakes. They cannot see the whole system and the whole complexities of the financial space and of the markets and economy space, which means that when you're an investor, it's always about your decisions, and if you're making money, you should know that you're making money because of your decisions, and if you're losing money, you have to know that you're losing money because of your decisions. Confidence and having a sound strategy that you believe in is the most important thing in investments, hands down, and I believe anyone would say that. So once more, the 8 graphs, I believe this is very important, very, very important thing that we should remind ourselves, because you know it now, you remember it, but then you go out there, look at investments for a month or two, and you start forgetting, right? So please make sure you keep those things in your mind, because I believe they can give us much better gains and save us from some really hard pains. Thank you for listening to the Should I Buy It show. Make sure to subscribe. Take a look at my financial education playlist, where there is a lot of, I believe, quality and good information that you can find out. Also explore Antiversa. Antiversa is about knowledge and finding new exciting things. There is technology, there is successful mindset that I believe is also very helpful and will build up your life. Thank you for listening, and see you next time. Stay antiversal.